following is Lecture LM2D from Learning Module 2, Financial Management and Planning, Obtaining Financing for Your Tourism Business. An integral part of the planning process is determining how you are going to obtain financing or raise capital for your business, whether it is for a new tourism venture or to expand an existing one. There are primarily 5 ways to finance your new or growing business. First, financing may come from you or your partners themselves. It may be cash from savings or a credit card. According to a Global Entrepreneurship Monitor study, the average amount of startup funding for a new business in the United States is $70,000. Approximately 70% of this is provided by the entrepreneurs themselves. Related to this type of financing is the contribution by the owners of tangible and intangible assets, such as softwares or patents, and hard assets, such as computer equipment. Also, the long hours worked by business owners, beyond that which is compensated for by salary, is often considered by many a form of financing by the business owner or owners. A second approach focuses on an existing business. Finances may be raised through the earnings of the business itself. That is, the business uses profits to finance business expansion. This approach may help ensure that the business does not grow more quickly than it can handle, since funding of the expansion is limited to that available within the business. Third, there are opportunities for businesses to obtain gifts and grants. Because they do not require repayment or incur financing costs, they are highly desirable forms of financing. Gifts include things like cash, free use of facilities and equipment, unpaid labor by friends and family, or forgiveness of debt. Some forms of gifts given by the federal government are for certain types of investments, geographic areas, or to support specific populations. These take the form of tax abatements and tax credits, which are reductions in taxes owed by the business for engaging in certain activities. Business grants are primarily for research and commercialization efforts. They are difficult for startup low-technology businesses to acquire. Gifts and grants should be pursued with caution. Gifts may come with strings attached by the person providing the financial resources, and grants may have specific requirements connected with the awarding of the grant. Fourth, there is debt financing. This occurs when the business or business owner incurs debt by borrowing money. Finally, there's equity financing, where an investor will receive a percentage of ownership in a business in return for money. Next, I will spend some time talking more specifically about the characteristics and types of debt and equity financing that are available to tourism businesses. To finance through debt, the entrepreneur applies to and contracts with an individual or an organization that has money to loan and borrows that money. Financing your business through debt is called leveraging. The business signs a promissory note, which is a loan document that is a promise to pay a specific sum of money on or before a particular date back to the person or organization who is loaning them the money. Typically, the borrower makes monthly payments until the loan is fully paid off. The 2 components of that repayment are the principal portion, which is the amount of money that was actually loaned to the business, and the interest portion, which is the cost to the business of borrowing the money. This table provides a description of general types of debt financing that might be available to a tourism business. Commercial loans are business loans typically provided by a bank or other financial institution. Personal loans are loans taken out on your personal credit and used for the business. Leases are debts incurred for the rights to use specific types of property. Bonds are long-term debt instruments used by corporations and often municipalities and other government organizations to raise large sums of money. On the right side of this table, you see some of the common types of these debt categories and common terms that drive those loans. There are several advantages and disadvantages to obtaining financing through the use of debt vehicles such as loans. There are at least 4 advantages to using debt to finance your business. The lender has no say in the management, direction, or operation of the business, so long as loan payments are made and contracts are not violated. Loan payments are predictable. They do not change with the fortunes of the business. Loan payments can be set up so that they are matched with the seasonal sales of the business. This is an important consideration for many tourism businesses. Lenders do not share business profits because they hold no ownership interest. The lender holds a lien on the property, but the title is in your name. There are at least 5 disadvantages to using debt to finance your business. If loan payments are not made, the lender can force the business into bankruptcy. If the business is not incorporated and the owner defaults, the lender can take the home and possessions of the owner. Debt payments of interest increase the fixed costs of the business and thereby lower its reported profits. Periodic repayment of the debt decreases the cash flow available to the business. And lenders require regular financial reporting and compliance with the loan contracts. Equity means that, in return for providing financing or money to the business, an investor will receive part ownership in a company. This ownership is generally expressed in terms of a percent ownership. For example, if a business is valued at $12,000 and an investor has put in $1,200 of that value, that investor is said to own 10% of the business. The investor hopes that the 10% investment in the business will increase from $1,200 to much higher in the future. As a company earns a profit over time, the investor reaps the benefit of that growth through the receipt of dividends, if the business is a corporation and if that business pays out dividends, the increase in the value of the shares of stock that represent the investment in the corporation, and a portion of those profits as a payout to partners or a sole proprietor. There are several advantages and disadvantages to obtaining financing through the use of equity investment. There are at least 4 advantages to using equity to finance your tourism business. If the business does not make a profit, the investor does not get paid. There are no required regular payments in the form of principal or interest, and dividends for common stockholders are at the discretion of the board of directors. The equity investor cannot force the business into bankruptcy in order to recoup the investment. Equity investors have an interest in seeing the business succeed, and if qualified, may share contacts, advice, and expertise. There are at least 4 disadvantages to using equity to finance your tourism business. Through giving up too much ownership interest, the business owner could lose control of the business to equity investors who have an ownership interest. Even with small amounts of equity, some investors may interfere with the business via unsolicited advice and/or continuous inquiries. Equity financing is riskier for the investor, so the investor frequently wants to be able to influence how the company is run and expects to receive a higher rate of return than a lender. The business owner must share profits with other equity investors. The following 2 slides of this lecture show a table that provides information about a variety of potential sources of financing for tourism or any other enterprise. Not all will apply to a specific business type, but should provide you, the student, with a broad understanding of the diversity of potential sources of financing for a tourism business or organization. This table is also provided as a PDF file on your course website. This table provides the following information: financing source, what category this source of financing falls under, debt, equity, grant, or other, the type of financing this source represents, the uses of funds that are required or expected for this type of financing, and additional notes about financing. For many of these sources, an internet link is provided that will give you additional information about the specific source of financing. I encourage you to spend some time looking through this list of financing sources, as well as exploring the internet links provided. There are a great many sources of financing that are available to businesses of all types and sizes. It behooves you to make yourself as familiar as possible to the various options you might have. Shown is the first of 2 pages, listing out these various types of financing. Note across the top the financing source, the category of financing, the uses of funds, and notes related to those specific financing sources. As you move down the left column, you will see a variety of these have internet links that you can access and learn more about that particular source. Again, this 2-page table is available as a PDF file on your course website, and I encourage you to review that to make yourself as familiar as possible to the variety of financing sources available to you. This ends Lecture LM2D on obtaining financing for your tourism business and completes all the lectures from Learning Module 2.